Hey folks, welcome back to the channel. We're going to talk about 0 days to expiration. These are options that expire on the day that you trade them. So for example, today is Monday, the 24th. So I will be selling options that are expiring today. And what I'll be doing throughout this entire week is to sell 0 DTE options every day of this week. So I'll go through my thought process and talk about the strategy that seems to work for me right now. I'll probably make changes to it over time, but you guys can give some feedback as well if you think any parts can be improved. So here's my basic strategy. I will take an index fund, such as Invesco Triple Q, and then I will sell a vertical spread that is out of the money expiring today. So for example, looking at the ETF now, it went down in the morning and then it bounced, so that overall the trend is heading higher. And you can tell because if you connect the opening price to the price right now, it's an upward slope. So because the momentum is going higher, I want to sell a put option spread, which will give me a higher chance of my options expiring worthless. On Mondays, Wednesdays, and Fridays, there are ETFs such as QQQ that have intra-week expirations. So you can trade 0 days to expiration options on those days. And then on Tuesday and Thursday, you can use SPX, which I'll get into tomorrow. But for now, I'll list a few ETFs that I like to use. So there's this one, and also the Spider S&P 500 or SPY, and then also IWM, which is the iShares Russell 2000, which tracks a larger basket of stocks, including a lot of small cap stocks. So in terms of when I trade during the day, I always wait until 9:30 a.m. or later Western time, so that would be like 12:30 for the New York Stock Exchange on the East Coast. And the reason is because during the morning, as you can see here with IWM, it's very choppy because most volume during the day happens in the morning. And then as the trading session goes on, you get less volume, so therefore less volatility. And when you're selling options and trying to take advantage of time decay, of course, it's all about trying to maximize theta decay as well as dropping implied volatility. But that would be like the first guideline I would follow is don't trade before 9:30 in the morning because it's very difficult to know which way the ETF will go. Now, in terms of which ETF I choose, generally I'll just choose one of these. And the way I choose is I look at the IV rank of these. So the IV rank tells me how high the implied volatility is relative to the past 13 weeks in this case. So basically, I just scroll down to those three ETFs that I mentioned. So for IWM, the IV rank is 79, so that's pretty high. So basically, it goes from 0 to 100, 100 being the highest, and then I'll go to QQQ, and that one is 76. And for SPY, right here, that's 81. So it looks like the Spider S&P 500 has the highest IV rank. This will change intraday as well, but right now this is the highest at 81. So I'm probably going to go with that because the higher the implied volatility, the more premiums I can make with the options. So it's 9:52 now. I'm going to look at the ETF first, and you can use any graphing tool you like. There's TradingView, there's Yahoo Finance. You can use IB as well. What I do is go to the 5-day, and I put these vertical lines in here. As you can see in Yahoo Finance, you can just click on draw and then click here, and then you can choose like vertical or horizontal lines, and you can just click, and it just adds these lines. If you want to remove them, you just right click on them and it deletes those lines. So I typically have 4 vertical lines in my view, and those create these 3 sections, 1, 2, 3, and each of these sections represents a day. And right now, as you can see, we're looking at today's section over here. And the reason I have like this one over here is just because I want to get an idea, just to visualize how wide each day is. So this is more of an art than a science, but I basically look at what the stock is doing today first, and I see there's an up move and a down move. For consistency, I'm just going to be using Eastern time. Every day the market closes at 4, so I have this one over here which starts at 9:30 tomorrow on the 25th. But if I go like 5 minutes before, then that's 3:55 today. So this line is where the market's going to end today. In the morning at like 10:30, the market wasn't sure which way to go. However, now it's a little bit more clear that we are going to go up because I have the Bollinger Band here, which helps to visually tell you that, yes, the stock market is going up. And that's what this like peach highlighted area is. So if you want to turn on the Bollinger Bands, you can just go indicators, and then it's this one right here. And I just leave it at default. So it gives me this. So after I determine for today which way the ETF is going, which looks like it's going up, then I look at the previous day and I see if there's any continuation in the pattern. in this case there is. So that gives me even more confidence that the ETF will continue to go up, because not only do you have the trend from today, but also there's that momentum from the previous day, which was Friday last week. And it just means that if the ETF were to drop right now, it would have to face a lot of support levels on the way down. Typically, I would set my strike price to below the lowest point of the day. So this is the lowest point of the day right here. That looks like about the 373 level. So I'll put a line there first. And I want it to be a little bit below that, so maybe around 372. And that's where I will sell my option to start the spread. And then I will have another put option that I will buy for protection, usually $1 down, so at 371, which is around here. So let's take a look at the option chain for SPY and look at what kind of premiums I can get. It's usually not much. It's like 4 or 5 cents. And then what I do is I just rack up the number of contracts. Now, one disadvantage of this strategy that I use is that you do have to pay a lot of commissions. Overall, I still make a net profit, of course. Otherwise, I wouldn't be doing it. But I haven't found a way to really reduce the transaction cost, because there's a lot of friction to this strategy, as you'll see. Okay, so what did I say? It's 372 and 371. Let's take a look at that. So make sure I'm on the 0 days here, October 24th. If I hover my mouse over this, it tells me how many standard deviations. I typically like to go 3 or more. So 3.7 is good, 3 basically right on the edge. 2.4 is too risky. I don't do that one. So 372 looks like that's a 6 cents, 6 to 7 cents. And for the 371, that's a 4 cent. So that's about a 1 or 2, let's say 2 cent difference between the two. Right. So if I sell this leg and then I buy the one above it, 371, I'm making 6 cents from selling the 372 put option, and I have to pay somebody 4 cents for the 371 put option. Okay. And then for my limit here, I'm going to choose 2. And for the amount of contracts here, I'm going to go with maybe 50. You can see it doesn't use a lot of margin. Okay, and if I hit submit order, you can see after commissions, I'll only make about $41. So not a lot, but this is very low risk, since at 372, the delta there is 6.8. So more than a 93% chance that this will expire out of the money. So I have put that order in, and we can see it over here in orders. If this continues to drop, then my orders should get filled.
Order partially filled.
Okay, it looks like 9 out of my 50 contracts got filled. So let's wait and see if the rest of these 41 contracts get filled at this price.
Order filled.
Oh, it looks like, yeah, so the rest of those got filled, all at 2 cents. And the commission, yeah, it's not bad, $30. And I made $100 in premiums from that trade, because 50 times $2 and then minus 30. So that's a net premium of $70. Of course, I can't say that too soon because the day's not over, and I may have to close this position and take a loss. So the idea is, if the price doesn't really move much, if it just stays above, say, 375, and it just goes up and down in this level, then I'm not really going to be worried. The options that I have will all expire worthless, and my profit for the day would be $70. Usually near the end of the trading session, like maybe 1 or 2 hours left, if I notice that the ETF is pretty steady, then I might sell another option on the other side. So in other words, I will sell like a vertical call spread. So in terms of what I'm risking here, my spread is $1, right? So the most I can lose is $1 times 50 contracts, but then each contract is worth 100 shares. So I'm basically on the hook to potentially lose $5,000, or 5,000 minus the 70 premiums that I made. So which is not helping too much. But that's basically my like worst case scenario. Now with 0 day trades, you want to keep an eye on things so that it never gets to that kind of loss. Because if this ETF goes down enough in price, I'll just close my position. But we haven't seen that yet. So looking at the price right now, so it has come down, but still within reason. The thing is, as long as we end the day higher than basically this line right here, I'm going to make that thicker. So as long as the price remains above this thick purple line, then I'm going to make 100% of the proceeds. So we'll have to see. We can also check what my position is worth right now. If I go to combo in my account portfolio and look at SPY. So here you can see the price of this option spread is now 3 cents. And remember, I sold it at 2. So if I waited until now, I could have made 3 cents per contract instead of 2 cents, which would be better. But because I didn't know like how much this would fall, I picked a spread that was pretty far away from the current price. So this gives me that margin of safety. So let's check back in maybe an hour or so and see what the price is doing at that time. Okay, so it's 3 p.m. Eastern. There's about another hour of trading left. SPY came down after I sold the puts and then it continued its upward movement in line with the direction from earlier this morning. So that's why it's really important to wait a few hours after market opens because you'll be more likely to get the direction correct. Looking at an update of my SPY spread here, I have an unrealized profit of $52. By the end of today, I'm assuming this is not going to come all the way down to my 372 strike here. So this is the unrealized profit right now. You can see the current value of this spread strategy is $18. By the end of today, if this goes to zero, which I assume it will, then you just add those together and that's $70, which is the $100 premium because 50 contracts times my original 2 cents times 100 shares minus the $30 commission. You can see the slope of this recent incline getting more flat at the top here. And you can also tell by the top of this Bollinger Band. Now, because I've already used a put spread down here, which used up margin, if I sell a symmetrical call spread, then I don't need additional margin room for that. So I'll show you what I mean. If I draw a line, and this is the first thing I'm going to do is to draw a horizontal line that approximates this bullish trend starting from this afternoon. And I'm looking at where it might end the day, which is over here at 381. So if I go up to like 382, so I'm going to move this up here to about 382. If I sell a call option at 382, there is a very high chance that it will expire out of the money. And if I do the spread and buy, let's say the 383, then that is a $1 spread, and I can do another 50 of those without using additional margin room. So for example, in the option chain here at 381, we're looking at 2.5, 4.3, 4.2, it just went down a bit. So if I sell this and if I buy the 383, that looks about like a $3 difference. And if I increase the quantity to 50, just to show you the margin impact here is 0. Now, if I go higher than that, like 51, then it starts to ask me for additional margin. And the reason at 50 or below, it doesn't ask me for more margin is because I have the other put option spread at also with a $1 spread between my long and short option positions and a quantity of 50 contracts. So if I put this through, I can make another $100. But that is quite risky because I am assuming that ETF will end below 382, which it might not, right? Because there is always a chance that we could get a pop up and I could be very deep in the money here and lose like thousands of dollars. So this is where you have to be careful. Only 45 minutes left in the trading session, but then you also have to consider after hours trading because sometimes I'll get like an option exercised against me after 4 p.m. Eastern. So I usually like to leave like some wiggle room. But going back to the option chain here, so maybe 50 is a little bit too high risk. Maybe I'll drop this down to 10. So the most I can lose is $1,000. If I submit this, I can make basically $20 if it goes through.
Order partially filled. Order partially filled.
All right, so those 10 contracts went through and it looks like I paid $11 in commission. So that would be a net premium of $19. So as long as SPY continues along this channel, and I can draw another line over here to show the narrow channel this is currently trading in. So as long as it stays within here, then I'm good. If we get any candles above this top line, then I'll probably close my position because then there's a good chance that I could be in the money by the end of today. So let's check back later and see how things are doing. Okay, so it's the end of the day. SPY did not hold that channel. It broke towards the downside, which is good in my case. And the stock finished below my 382 call strike. and above my 372 put strike, which means both of those option spreads expired out of the money. So unrealized profit and loss, this will become realized after today, after these expire. So it's 63 plus, I don't know why there's still $7 of value left remaining, but that's going to get added together. So that'll be 70 and this will be 18, the 16 plus the 2. So that's about $90 for today. And this unrealized profit and loss takes into consideration. So this is the net profit. Now, if this had broken out towards the upside, then I would have probably closed out of my 382 spread position because that would be way too risky. But luckily, it did not do that, so I just let everything expire worthless. So that's it for today. Let's head over to tomorrow for another trading day. Hey folks, today is Tuesday, and we're going to look at the S&P 500 index because on Tuesdays and Thursdays, the SPY and QQQ and other ETFs don't have expiration dates. They only expire on Monday, Wednesdays, and Fridays, whereas the SPX option, which is what I'm going to look at today, has expiration days every day of the week, except for weekends, of course. So for 0 days to expiration trades, this is what I will be looking at, especially on Tuesdays and Thursdays. Overall, it looks like the market is going up. These vertical lines here represent days. So I have this one on the right, which represents the end of today. And overall, the market is going up. You can see by the Bollinger Band, it is kind of on an upward movement, especially early in the morning. But then it became kind of flat recently. So by the end of the day, I have to figure out where the index is likely to end, and I'm going to choose a strike price that is out of the money. So because the trend is going up, I will be selling another put spread. The price started today around here, 37.93. So I'm going to want to have a strike below that, maybe around 37.90 or 37.85. And for the SPX options, the pricing is in $5 increments, as I'll show in a minute. And that's why I'm thinking the 37.90 seems like a pretty good place to put it because there's a lot of support as it comes down. Even if it fills this gap over here, there's a nice support over here at 38.09. Plus, you have the 100 moving average, which is this pink line, which will act as support on its way down as well. And the reason I'm not going to sell call options right now is because I don't want to fight the trend. You can see yesterday, even though it kind of stayed pretty flat in the middle of the day, even though it had an upward trend, at the end of the day, it still went up a little bit. So we could see a similar pattern here where it's just going flat a little bit, but then it might go up again. So there's a bigger chance it'll go up than down. And therefore, I'm going to sell a put because selling a call will have a higher risk of it going into the money. So at 37, I'm going to put a line over here. That's roughly where I'm going to look at in the option chain to sell my option. And the idea is the price will not fall below this line by the end of the day. So in interactive brokers, if you just type in SPX, it's the first one that comes up. It's the S&P 500 index, and this is for the options. As you can see, October 25th, 26th, 27th. So there's one expiration for every weekday. Now, the one I'm looking at is this one, 0 days. So 3790 is here. That's a 5. That's a 5 delta. So that's a 5 delta and a 4.9 standard deviation. Okay, so I can make about 25 cents there. And the reason the premiums are so high is because the price of this is also very high. It's basically $3,800 for one share, essentially. So if I sell one contract, then that's like $380,000 or something. But that's why you have to use spreads for these. Otherwise, you'll need quite a lot of margin requirement. Okay, so I'll turn on Strategy Builder, come to 3790, click on the sell leg, and then I'll go up to maybe the 3780, and that's about a $10 spread there. If I go down here, I can choose the mid price of 10, and maybe I'll choose 10 for the quantity. And this will make about $81 after commission, so I will submit that.
Order filled.
Okay, so that order just filled over here. I sold the 37.90 for 30 cents, and I bought the 37.80 for 20 cents. So that's a $10 spread, and I have a quantity of 10, so that's $100 minus the $24 commission, so that'll be about $76 if I don't have to close this, and both of those options expire worthless. So I'm going to put in another line over here, which is right at the bottom of this candle wick here. And that's going to be the like short-term support because if it falls below that, I might have to close my position. However, if it continues to stay within like the current range it's at now and above this line, which is at 38.24, then I shouldn't really have to worry. It should either just consolidate around this area or go up higher, like what happened yesterday. So let's check back to see how this is doing later today. Okay, so we're nearing the end of the day now. There's about 20 minutes left in the trading period. As expected, the S&P 500 did not cross below this line here, so I'm going to get rid of that. My strike price down here, 37.90. There's virtually no chance of it reaching there because if I take a look at the option chain at 37.90, there's less than a 1% chance it will close in the money. So I'm basically going to call it and say it's not going to fall that much over the next 20 minutes. And what that means is it's another profitable trading day. Here's the trade I put on this morning. If I close my position now, I make a profit of $65, but there's still like $11 of value remaining, which will go to zero by the end of today. So add it all together, that's about $75. So that'll do it for today. Let's jump over to tomorrow. Hey everyone, it's Wednesday. Microsoft and Google announced earnings yesterday, and they both disappointed. However, the stock market is rebounding. So we're 3 hours into the trading session, about halfway through the day. Let's take a look at what I can do for today's trade. So not as volatile as the previous couple of days. IWM, we have an IV rank of 61. For QQQ, 60 and for SPY 64. So it looks like I'm going to be trading the Spider S&P 500 again, currently at 386. Let's take a look at the chart and figure out which direction it's going. So started the day kind of low, but overall we're still on this very bullish trend going up. And unless something really bad happens, it's likely to continue. So if you look at this red line going up here, this is the 100 moving average. And the market seems to be consistently above this, except for this morning. This vertical line here on the right represents the end of today and the start of tomorrow. It's actually very similar to what happened yesterday, where we had a rise and then it sort of came down a little bit during the middle of the day, and we're sort of seeing that again. So, because the direction is going up, I will again be selling a put spread. And for the price, I'm going to take the lowest price that the market saw today, which is around the 381 level, and I'm going to lower that by a couple of points. So maybe like 380 or even 379. 379 would be safer as there is another support over here from 2 days ago. But let's take a look at the option chain and see what we can do. 379, I can't really get a lot of premiums out of it, so maybe 380 is good. Even 381. It looks like we're still going down. If I go to the minute chart, yeah, so I'm actually going to wait and see if this bounces from the 200-minute moving average, which is this purple line, because if it goes through that, then I'll probably wait until I see it close. But you can see from yesterday, the market closed around the 385 level. So we could see a bounce from that fairly soon here as we approach that price. Okay, so it's been a few minutes later and SPY is continuing to fall. We've basically dropped to the 200 moving average and maybe it'll hold. I'm not sure. We do have support a little bit lower from earlier this morning and also from the previous day, but the sellers look to be pretty aggressive right now. And we just broke below that, and oh, it looks like buyers are coming back in. But if we close this candle in this next minute below this line, then I'm going to wait until I see a more clear confirmation of where this trend is going. Because if I sell the put option right now as the price is dropping, then the option will be worth more as it falls, right? And because I'm short selling the put option, I want the option to be worth less. And eventually be worthless by the end of the day when it expires. So sometimes just have to be patient and wait a little bit before jumping in. So we'll come back later and check on this. All right, let's take a look at this now. The SPY is continuing to fall. I wonder what's going on. There must be some kind of news. If this downward momentum continues, we could easily reach like 380 by the end of today. So I'm still going to wait and see what happens. Okay, it looks like we've finally reached some kind of bottom, and there was a nice bounce from that. Just double checking on the 1 minute chart. You can see we're getting higher lows. So the trend is now at least stabilized and somewhat going up. So now I can go into the option chain. I'm not going to get too much money from the 379, but the 380 I can get 8 cents for that. So if I sell this one and I buy the one before that, 379, that's a $1 spread, and I can make about 4 cents it looks like. Let's go with 60 for the contract, and that will make about 170. So I'll submit that.
Order partially filled.
16 contracts have been filled. Just waiting for the others now.
Order partially filled. Order filled.
Okay, so all 60 contracts are filled at 4 cents. So that's good. So at 380, I'm going to put the line over here. Basically, if it finished the day above this 200 moving average, then I'm not going to do anything about it. But if it falls below that, then I may get out of my position. And usually I get out at a loss if a trade goes against me. But as you can see, this has a delta of about 10%. So most of the time, I don't have to do anything, and the option just becomes worthless. Okay, so another update. There's about 9 minutes remaining in the trading session, and it's pretty clear that we're probably not going to get all the way down to 380. Right now it's at 382 and a half. It did fall below this purple line here, but I was looking back at the past 2 days, and it seems to be a pretty strong support level right around here. So I was hesitant to sell it when it broke below this 200 moving average, but I wanted to wait to see if we get a bounce, and it looked like we did. So there was a nice rebound there. And if we take a look at my option here, so for the SPY, each contract I sold for 4 cents. And then I paid $65 in commission. So 4 times 60 contracts, that's my gross premium, and then minus $65. So if the contracts, if all of these options, if all these 60 contracts expire worthless, then my net income would be 175 for today. Taking a look at my account here, the SPY 380, 379 bull put. Right now, if I sell this position, I'm going to make $102 minus whatever the commission is to close it. But if you take the 102 and assuming the option expires worthless, you add the $73 of remaining value, and that gives you the 175 as mentioned earlier. And there's about 5 minutes to go. It looks like we're going to stay within this Bollinger Band, the top and the bottom of the bands, because the price has touched the bottom and it bounced off of there, but it wasn't strong enough to go to the top. So it looks like we're just going to close around here. There's one candlestick left for the day. So it was pretty close earlier. I almost sold it. If it had fell to like 381, then I would have got rid of my options and taken the loss and then try to make it back some other day. But it looks like the options will expire out of the money. So that'll do it for today. And let's move on to tomorrow, the 27th. All right, so it is Thursday at 12:37 Eastern Time, and let's take a look at what the market is doing today. Looking at this block right here between this vertical line and this one, it's not too obvious what the trend is looking like, but if you draw a line from the start of the day to now, you can see it is down about 16 points. So overall, the market for today at least is trending downwards, and that means I'm going to be selling call spreads. And I'll be using SPX again because on Tuesdays and Thursdays, SPY and other ETFs are not available for 0 DTE trades. So where should I set my target price? Well, if the overall trend is going down, then I want to set it at least to the highest point of today, which is here. So that's at 38.60, which is pretty far away from the current price, but I always like to have a little bit of margin of safety. So I might put it around the 38.70, just $10 higher. It's not likely for the market to reverse and roar back up to 38.70. It'll have to go past a lot of resistance. And looking at the 38.70, so that's 3.5 standard deviation, and I'll make about 30 cents from that. That's pretty good. Again, I always want to choose Like before, I typically want to choose something over 3 standard deviations. So like over here, 2.8, that's too risky, but here is pretty good. I can even go with a 38.65 if I was more confident with the chart, but because it's quite choppy today, you can see the lines, these bars are longer today than generally speaking yesterday, right? So what that means is it's more volatile. So I think 38.70 would be pretty good. And then maybe I'll buy the 38.75. This will give me a $10 spread. And let's go with 10 contracts. So that'll be $81 if it fills.
Order filled.
Okay, so those SPX options have been filled. So I sold the 38.70 call for 37 cents, and then I bought the 38.75 for 27, to $10 difference. And overall, similar to last time, I paid $24 in commission. So that's a net premium of $76.
Order filled.
All right, so we're at the end of the day, and what I just did is sell another bear call at the 38.30 level. So at 38.30, very low chance of that expiring in the money. So I sold 38.30, bought 38.35, and it's only 3 contracts because I want to make a little bit of money, but I don't want to be risking too much. So 3 contracts should be able to make 3 times 10 is 30 minus $7, about $23 with that. So this is what this looks like. My 38.70 bear call that I put in this morning, that's basically worthless right now. Other bear call that I just put in like a couple minutes ago, it looks like that is already going to expire out of the money as long as over the next like 7 minutes, the S&P 500 stays below this level right here, which looks like it will be. So I'll be keeping an eye on this for the next 5 or 6 minutes. Okay, and now markets are closed. It looks like the S&P 500 closed at 38.08, which is below my 38.30 short call. So everything expired, worthless. Now let's go to tomorrow for the final day for trading 0 days to expiration. And tomorrow will be interesting because there's a lot of stocks as well as ETFs, not just index funds, that expire on Friday. They have weekly expirations. So you have like Amazon, Alphabet, a bunch of other companies that you can do 0 DTEs on Fridays. I would still prefer to use this strategy on indexes just because you won't be faced with like a concentrated move with one single stock. So let's jump over to tomorrow for the final day of trading. All right, so it's Friday the 28th, and it's about 1 p.m. Eastern. So there's a few more hours of trading left. We're about halfway through the day, and it looks like the market is going up. I'm looking at the SPY right now. Most likely it's going to end the day higher, so I'm going to look for the lowest point it reached today, which is around the 181 level. So at 381, I can get 6 or 7 cents. That's a 6 delta. Maybe I'll go to the 379 strike and buy that. So that should give me like a 3-cent spread. And for the quantity, maybe I'll do 30. That's going to use up about $8,000 of margin, and I'll make $62 after commission, roughly. Looking at the last couple of days, there is a resistance line right around here from Wednesday. So it'll be a challenge for SPY to increase past that level. Okay, so it's been about half an hour later, and it looks like SPY did in fact breach that resistance and is now trading higher. So this is very bullish, at least for today. So I'm going to have to change my tactics here because the bull spread that I put in at 381, it's not going to get filled. I mean, one got filled, 1 out of 30. But right now the average price of the spread is 0.01, and that's just not worth it. So I'm going to cancel this spread
Order
and I'm going to
cancelled.
make a new one. So instead of at 381, maybe I'll choose something a little bit higher at 382 or 383. So around 383 would be this level right here, which is below all of these moving averages, including this 100 moving average. So I think that's pretty safe. So I'm just moving my short put strike from 181 to about 183. And let's see what the premiums are. So at 383, I'm looking at a 6 cents again, so very similar to before. So I will sell this, and I'll go for 30 again.
Order partially filled. Order filled.
Okay, so the SPY 383 and 381 bull put spread has been filled. Each pair of contracts is 3 cents times 30, so that's $90. So half of that went to commission. So we'll see what happens at the end of the day. Hopefully it stays high and does not come close to the 383 level. But if it does, then I might get out of the position. And when I would sell and take a loss is if the price comes down enough that I start losing like 3 times what my gross profit would be. So in this case, it's $90. So 90 times 3 is 270. So at around a loss of somewhere between 250 and 300, I would probably get out of that position. And looking at the accounts here, one way to tell is this is the option I have. It's 29 because the other one I had earlier had one fill at $3. But in any case, if this market price here goes from minus 0.03 to minus 0.09, then that would basically be 3 times what I intended to make originally. So at that point, the market value here would say about 300 or 290 around that range. And then I would close out this position here. All right, so it's the end of a bullish day. There's just a couple minutes left in the trading session, and SPY continues to go up. Okay, so let's wrap things up. This is how much money I made each day of this week using this strategy for a total of $485. So that's roughly $100 a day. What I like about 0-day trades is there's no carryover risk to the next day. Your position either has to expire like on the day or you close and get out of the position. But either way, you don't care about what the stock is going to do tomorrow because that's a new day. Now, there are some downsides with this strategy. The first one being you can lose a lot of money, like 10 times what your potential gain is if you're not careful. So you'll have to watch your positions and make sure your options don't expire in the money. And then, of course, the other issue is high fees relative to the gains that you're getting. So I haven't really found a way around that yet. Maybe one way is to sell the option spreads closer to in the money and then just have a tighter stop loss. And then that way you can reduce the number of contracts because each option spread will be worth more. I'm not sure yet, but that's something I still have to play with. But basically, this is the strategy. On every day of the week, you can use the SPX, but on Mondays, Wednesdays, and Fridays, you can use specific ETFs to trade 0 days. The first thing you do is determine the market trend. And I like to use the 5-minute chart. I think it does a pretty good job of showing which way the market is going. And if the trend is up, then you can sell put spreads. If the market is going down in general, then you sell call spreads because those are less likely to expire in the money. And just to review a few notes to increase your chances of success with this trade, don't trade before 12:30 p.m. Eastern. So you want to wait at least 3 hours after the market opens because it'll be a lot easier to see where the trend is going, right? And that's really important because as you saw in all of the days this week, if it looked like the market was going up, then it ended the day higher. If it looks like the market is going down, then it ended the day lower. This is a really good indicator. So whichever way the market is going in the first 3 hours tends to be where it's going to continue going. It's not always the case, but that's why you have stop losses. So the second tip is to be really disciplined and keep your stop losses tight. So for example, I sell a spread that's worth 10 cents and I have 10 contracts. So that's $100 before commissions that I would collect. Now, if the stock were to move against me and the option becomes more and more valuable and it turns into 30 cents, then I'm going to consider getting out of that position. So that would be a 200% loss because I sold it for 100 and I have to buy it back at $300. So in that situation, I will be losing money. But the thing is that doesn't happen very often. And most of the time, like we saw this week, I didn't have to close any of my positions. But you don't want to wait until that option becomes like 40 cents or 50 cents, because then you'll be losing like $400 a trade. And at that point, you're going to need a lot of winning trades just to cover one single loss. And then to help you decrease the chances of getting stopped out of your options, you can just choose strike prices that are very out of the money with like single digit deltas. So most of the time you should be fine. And kind of one bonus tip is you don't have to stay in front of your computer and watch the market every minute. You can set up alerts or stop losses automatically, where you can say if the value of the underlying drops to a certain amount, then send me an email, give me a text message, and basically alert me to it, and then I can go manage the trade. You can also set stop losses on your options. So you basically put on a trade, but it will only execute when the price reaches a certain level. And that way you don't even have to worry about having access to the trading platform for the rest of the day. Because if the underlying goes against you at a certain price, then you will close your option spread position, and then you won't risk any more losses after that. So stop losses are a really powerful risk management tool, and I definitely recommend you checking that out. So this is just one 0 days to expiration strategy. There are others out there. Let me know if you have any suggestions to make this work better, or if you prefer a different kind of setup. Anyway, thanks a lot for watching. Good luck with your investments, and I'll talk to you in the next one.